Hello everyone, thank you for watching TrvLrn with Jay. This is me Janeta and I'm back with another episode in our stock market series. So in this video, I'm going to share 5 do's and 5 don'ts which is very important if you are a beginner in stock market. So watch the video till the end and let's start. Also, if you're new to this channel, I post videos related to finance, learning and traveling every week. Don't forget to subscribe. Start with small capital in initial days. So for example, if you ask me, when I opened my Demat account, I didn't have much money and I was also hesitant to put huge amount at the start. So what I did, I started trading with an initial amount of ₹5,000 rupees. That's it. You can also do the same thing. You can start with a small amount at the start and you can consistently invest each month 2k, 5k or whatever amount that you can afford. So the second is use a demo trading app to improve your trade accuracy. This is very important because whenever you place an order to buy or sell shares, you have to enter correct values in the price and quantity field. You cannot make a mistake of a small zero or an extra zero, less zero, because it will put you into a great trouble. So it is very important if you're new or you're a beginner to the stock market. There are ample of applications available to learn trading. You can download any app and you can learn and follow shares that you want to buy. The third important point is understand the technical and fundamental analysis. Technical and fundamental analysis are both two different terms. Fundamental analysis is to measure the intrinsic, you may say the basic or the natural value of share price, whereas technical analysis is more of the statistical data or trends of the volume and stock prices. So both of this analysis is used to research and forecast future trends of stock prices. Try to understand the financial reports of the company. Financial reports as in the balance sheet, the quarterly reports of the company. This will give you a judgment and understanding of the company's performance over a particular period of time. It is very important that you follow the particular reports of the company so that you understand if this company is going to make a profit in future. So we are at the most important, the last point in the do's list, that is have a stop loss. This is very important. Whenever you place an order to buy shares, always have a stop loss. You have to decide how much risk or loss you're able to afford so that if the share prices falls to that particular price, the shares are automatically sold off. You do not have to bear more losses other than what you decide. So always have a stop loss. So let's begin with the list of don'ts for the beginners in stock market. So the first is do not trade stocks that are in news for good or bad reasons. Do not invest in any shares just because they are in news right now. This may be kind of a trap because once you buy the shares, the share prices will start falling. Point number 2, that is stay away from external advice. When I say external advice, I mean do not get influenced by your friends or do not buy shares just because your friend is buying. Do your own research. Always make a study of your own so that you know where you are investing. You know the company better. So always make your own judgments and make your own research. The point number 3 is do not invest the money you need. Always invest that amount that you're ready to lose. Do not invest your hard-earned money or your savings. Always invest the amount that you have extra. Okay? This one is very interesting because this happens with everyone. That is, do not get attached to any stock emotionally. This is very important, and you know why this happens? Because when you start doing your own research and you follow that particular company, and also if any news comes about that particular company, you are like you have to read it what is happening. So this is kind of emotionally you are getting attached to that particular stock. So you don't have to do this at all. Do not get attached to any stocks emotionally. Once you get your profit, just exit, just sell them off. So the last don't in our list is don't put all your eggs in one basket. This is an old age principle that you might have already heard. This particular point means spread your equity investment across sectors, for example like IT, banking, pharma, etc. This is because that your performance of investment doesn't depend on particular sector or shares. So guys, that was all for today. Hope you liked this video. Please like, share and subscribe to my channel TrvLrn with Jay. And if you have any more points, please do mention in the comment box. I'll see you soon with another video in the stock market series. Till then, take care.